And then they come to the performance guarantee. And the court says, the High Court finds that performance guarantees provided by MOGAS constitute controlled transactions covered by the Danish TP rules. And just to be clear, MOGAS did not charge for these performance guarantees, right? And then the court says independent parties would have been paid an annual fee. The court emphasizes that the guarantees must be considered for the benefit of subsidiaries and in their favor. In addition, the guarantees were unlimited parent company guarantees that constitute more than just the capitalization moment. So, in other words, if there was an oil spill or something like that, then MOGAS would have been liable way beyond whatever capital there was in its subsidiaries. And this brings up an interesting point which the court and I believe the Danish authorities have not explored, but the point is this, right? If you look at chapter 10 on financial guarantees, there is a line of argument which possibly could have been followed here, right? And the line of argument would go something like this. If a subsidiary cannot get a service contract without a parent guarantee, then for TP purposes, it must be assumed that the service agreement was in fact awarded to the parent and that the parent subsequently subcontracted the subsidiary to perform the services on its behalf. Now, if you look at chapter 10, what it says is if a parent guarantees a loan for a subsidiary, which the subsidiary gets from the bank, then if the consequence of the guarantee is simply to lower the interest rate, then that is fine. Then it's a guarantee, and you've got to apply chapter 10. But if the consequence of the loan of the guarantee is that the subsidiary gets the loan at all, because it wouldn't have gotten it or it wouldn't have gotten that amount without the parent guarantee, then actually you need to requalify that loan as a loan from the bank to the parent, and then most likely a capital injection from the parent to the sub, because if the bank can't lend the sub that money, then under transfer pricing rules, the parent should not be able to either, right? Because third parties wouldn't have done it. So you could use that line of argument here, and it would align with Scott's argument, you know, that somehow MOGAS kept the economic interest in these licenses, because it's very clear that if the countries require a parent guarantee, then they are not comfortable with giving these licenses to empty shells, because indeed what happens if there is an oil spill? Then you just let the company go bankrupt and you walk away. You can't do that. So the countries want parent guarantees. They won't give the licenses, or they won't allow the license to be assigned to the subsidiaries without the parent guarantee. So maybe one should say for TP purposes that it is actually still the parent that has the license, and that it uses the subs as subcontractors, or it sub-licenses the license to the subs, and then it would have been entitled to some kind of royalty or a much higher compensation than MOGAS it got itself. And then there's the other point. Remember, Algeria, the sub had no FTEs, or at least not in Algeria, right? And then if you take an AOA approach to the branch, then you would have to say, you know, there were no significant people functions performed by the PE in Algeria because there was no one to perform it. So does that mean that then that income must be allocated under a Chapter 6 intangibles kind of argument to MOGAS, because it, or at least the Algerian headquarters in Denmark, has done all the work? And I don't think you can do that in this case, because in this particular case, we remember we had Anna Dorak or something is the company's name, which was the operator. So one would have to say that the PE actually outsourced all its work to the local operator. It did not outsource that work to MOGAS, or at least not only to MOGAS. But I think this could be an interesting line of exploration for performance guarantees in general. And then if we come to the CUP for time writing fees, first the court explains what's going on. It says the time writing services provided to the subsidiaries have been mentioned in the TP documentation in the years in question. It appears that the services are provided at cost price and thus without a profit element or no markup. The remuneration is made from the CUP method. MOGAS refers to the prices and terms for independent parties in the G23 company cooperation, stating that they are internal CUPs. And I think what happened here is MOGAS, as operator in the DUC oil consortium in Denmark, provided these time writing services for free. And it argued, well, there is a CUP because we're doing this for Exxon and for Shell for free, then surely we can do it for ourselves for free as well. But then the court says MOGAS acts as the operator for G23 company, and again, I don't know what company this is named, but now we're back in the anonymous mode, on behalf of the company's parent, APMM, whose share in the G23 company collaboration is 39%. MOGAS has therefore not carried out a comparability analysis. When there are several investors in the same project that carry risk and gain, then it is not unnatural that one only gets the actual costs covered when it happens under the auspices of the investors. It does not make sense for others who are not part of the project to provide non-profit services when the project partners earn really well. It is noted for the sake of clarity that MOGAS is not an investor in the G23 business. So what the court says here is basically that you know what, I mean, if you are in a partnership and one of you do all the admin, but you all share in the profits and everything, then it's not strange that the one doing the admin is doing that for no compensation at all. But when you're not in a partnership and there's no profit sharing going on, then you should do this admin at a cost plus, right? So the court concludes, it says, furthermore, MOGAS has not identified transactions in which an independent company that does not receive a share in the potential revenues from oil production provide technical and administrative services without a profit element. The G23 company collaboration therefore does not constitute a suitable CUP. And you know, it comes back to CUPs in general. You really need to make sure that you match your comparability factors, right? And the court finishes this argument saying the High Court finds that MOGAS transfer pricing documentation regarding the technical and administrative assistance on time writing in the income years for 2006 and 2008 was not deficient to such a significant extent that it could be equated to a lack of documentation. And here the court has basically already said, you know what, there should have been a markup. And now the court deals with the question from the Danish authorities, oh, but the documentation must therefore be so bad that we can ignore it and we can make a pro forma assessment, and then the burden of proof is reversed and we're basically home free. And the court said that's not so easy. And it really is great that the court keeps holding this line, because it really is a go-to argument for the Danish tax authorities to try and reject documentation as quickly as possible to come to this reversal of the burden of proof. And that's just, it's dirty litigation tactics. It's not the way you win a case on technical grounds. Anyway, the High Court emphasized that the fact that the tax authorities disagree with or raise legitimate doubts about the comparability analysis in relation to MOGAS' delivery of the technical and administrative assistance does not in itself imply that the documentation is significantly deficient. I mean, documentation is significantly deficient when it is not there, right? So on this basis, the High Court finds that the Ministry of Taxation has proved that MOGAS' delivery of the technical and administrative assistance to the subsidiaries at cost price is outside the scope of what could have been achieved if the agreement had been entered into between independent parties, and there must be a plus. So that part of the case is done as well. And then both the local court and the High Court makes this point that they say a dividend is not a TP payment. The High Court agrees that income from dividends cannot be considered a business income in the sense that the dividends that MOGAS receives as owner do not constitute a payment for related party transactions. So what, I don't know whether that was the Maersk argument, but what one could say is, well, you know what, I mean, there was no royalty from the Algerian and the Qatarian subsidiaries or their branches to MOGAS, but there were dividend payments from these companies to MOGAS because both were MOGAS subsidiaries. Is that a payment for providing the licenses to these subsidiaries? And obviously the answer is no, right? So the court just reiterates this, but it raises an interesting question which the court again does not really address, but you come across this situation a lot, right? And this is what the OECD tried to address in Chapter 6 of the Transfer Pricing Guidelines, where they say, you know, if you are only the legal owner of an intangible, but you don't have the functions to manage the risk and to perform the functions required, then you must basically give all that proceeds to whoever are doing these functions for you, right? And that would apply. One would assume not only to companies which hold intangibles, but also to other companies, right? But there is a problem with this. In the short term, the OECD doctrine makes a lot of sense. If you transfer patents to a Swiss or to a Singapore or a Bermuda shell company with no people or only two bookkeepers who know nothing about what your real business is about, then and you start collecting royalties for those patents, then those royalties need to be transferred to whoever is doing all the significant functions, etc., etc. But what about the long term, right? Imagine, for instance, you are a group. This is quite a common phenomenon. You own your own real estate that you operate in the head office, and you put that real estate into a separate company so that if ever you want to sell the real estate, it is easy to sell the real estate, right? That separate company typically have no employees whatsoever. And what if that company then sells the real estate 20 years later? Should you then say, well, because the company has no employees, it couldn't possibly have performed the functions which were required to realize this significant capital gain on the real estate, and therefore the capital gain on the real estate must be allocated to another company, maybe even in another country? That to me seems unlikely. I don't think that reflects reality, and I don't think there are that much functions that are required in such a case. But obviously we're talking about a scale, a very broad scale of gray here, and one could ask oneself, would the same apply with regard to the Mogas companies? If many years later they sold these oil fields for a significant gain, or they simply could realize a significant gain through no doing of their own, it turns out that there was another huge field right next to the one that they were drilling in, and they discovered this by instance through horizontal drilling for the oil. Would that still be allocated to the parent company or whoever performed the significant functions? I don't think so. But again, the court keeps it here to just saying that dividend is not a TP payment, and I do agree with it, definitely with regard to short-term returns. And then again, one has to point out here that the significant functions for at least Algeria was not performed by Mogas, but they were performed by the oil field operator there, Anadarko. And then finally, the High Court decision. The court decides the assessment for Mogas taxable income for the income years 2006 and APM's joint taxable income for the same years are referred back to the tax authorities for reconsideration. Basically, the court says you've got this wrong, you need to redo it, but you got it significantly wrong, right? I mean, this was a huge assessment that they made, and therefore the court says that the Ministry of Taxation must also pay the legal fees for Mogas and APMM, both of them 3 million kroner, so about $1 million in total within 14 days. And I think it's quite significant that such a large fee compensation is made to a taxpayer. I hope you enjoyed this case. It raises a lot of questions. I looked at it at a very high level. I basically focused on the High Court decision only, and not on all the history of it and the decision of the lower court before that. But I think it nonetheless is insightful, and it's raising a number of interesting questions, especially with regard to the parent guarantees. Bye for now, and I look forward to seeing you at our next case.